Hi, this is Tony Daly, and in this video we're going to talk about butterfly spreads. And this will serve as a good introduction to how they are used and why you would use them. Now, if you haven't viewed the spread video yet, probably a good idea for you to look at that first, because a butterfly is actually a strategy that combines more than one spread. So it'll help if you have the basic understanding of how spreads work. But by definition, a butterfly spread is a neutral strategy, and it's a combination of actually two spreads. One is a bullish spread and another one is a bearish spread. And it's limited profit and it's limited risk, and you actually have to have three different strike prices involved. And you could use calls or puts. The risk graph is actually the same, so they're interchangeable. So for this illustration, we'll use calls. But basically, it is an advanced strategy, but it's actually very simple. And as we construct one and we explain it, I think you'll get it and see how advantageous they are and how you might want to incorporate them into your trading. So in this case, we're looking at LinkedIn, and we're going to go to the November expiration, and I have 10 strikes. And we're going to look at the calls. Now, butterflies, I said it was a neutral strategy, which basically means that the traditional way you would set up a butterfly spread is to basically have a bullish spread, which is what we learned in the spread video, which is where you buy and sell, buy at the money and sell and out of the money. And then you would also, for a butterfly spread, you will do a second spread and you will buy and at the money, and you will sell and in the money. And we're going to illustrate what that would look like and why you might want to do something like that. So let's say we're going to use 240 as our basis, and we're going to buy a butterfly, and you construct this right on your platform. And the computer will automatically set it up for you. And if you notice, you have two spreads here. And if we look at them separately, you will notice that the sum of the short strikes will equal the sum of the long strikes. So that balances you out, and that means you have no naked positions and everything is risk defined. I'm going to move these spreads out to $5 on either side so you could see it. So basically, I want you to look at this as two different spreads. We are going to, and break this in half. We have a 235, 240 call spread where we are buying one, and think of this as half of the butterfly. We're buying one and selling one, and that comprises the 235 and 240. And then on the other side, we're going to sell one and buy one. So one is a bullish spread, the other one is a bearish spread. And in some cases, they cancel each other out a lot, which allows you to put on this trade for a very, very small amount of money, because this portion would be the debit and this portion would be the credit. So you're always going to pay more for the debit portion than you are for the credit portion. That's why it is a debit spread. But this is risk defined. This is all you're going to put up for this trade. The maximum you could make on this trade is the width of the strikes minus what you paid, just like we learned in the spread video. So you notice that the risk is very small compared to the reward. And if we were to take a look at this on a risk graph, you'll see that, notice how it's a pyramid shape right here. And you'll see this flat line here and a flat line here. And notice the most you're going to lose here is $80. That's it. That's the most you could lose. Okay, it's the amount that we're going to spend. So how do we make money in this? What we want is, we need the stock to finish in between these break-evens here, which is basically these prices, the 235 and the 245. So if it finishes anywhere between 235 and 245, we can tend to profit on this trade. And our risk graph pretty much will tell us how much we will make depending on where it is. The goal of a butterfly is always to have it expire right in the middle. That's called your bullseye. And if that happens, you'll notice, if you look to the left, we'll make $402.70. Look at this number right here. If it expires there, you could make up to $410. So for an $80 payment, you can make $410 to $420, but it has to expire right in the middle. So we call these kind of lottery plays because it's very frequently the odds of that happening is not great. But the odds of it finishing, if it's a neutral strategy and you don't think the stock is going to move very much, it's very viable that it could finish somewhere in between here. So the idea behind a butterfly is to pick a range or pick an idea of where you think the stock is going to be and build a strategy or build a butterfly around it. So let me show you how I would do something like that. Let's say I wanted to do a weekly trade. This is going to be an actual trade that I would put on. Now this is a 7-day trade. Now, if I go over here on the Thinkorswim platform, Thinkorswim will tell me, based on the implied volatility, the one standard deviation measured move that the computer or the Greeks are projecting LinkedIn is going to move plus or minus $8 in 1 week. So I could use that. So I'm saying, okay, it's at 240. If I add $8.44, I'm somewhere around 248, 249. So let's say 250. So what I could do is I can actually build a butterfly and put a risk-defined, very cheap trade. I will go to 250 as my middle strike, and I am going to buy a butterfly. And I'm going to go 5 wide. So I'm moving a little fast here, but I'm going to explain everything. So basically, I have a 10 wide butterfly. I will have my lower strike at 245. My middle strike, which is my target, is 250. And then my upper strike is 255. And you'll notice this thing is only costing me 56 cents or $56. Now let's say I really wanted to play this up a little bit. I could do 5 of these. So I'm going to buy 5 of these. Notice you're always going to have double the amount of short strikes because these are 2 spreads. Remember that. This is one spread, buying the 245, selling the 250. Your other side of the trade is you're going to sell the 250 and buy the 255. Everything is risk defined. This is the most you could lose. So in this case, let's take a look at how we could do on this. So our max profit is incredibly $2,200. For that max profit, we're only going to pay $280. This is our trade with the commissions, and our broker is only requiring us to have $305 in our account because this is very inexpensive to put on. So basically, look at your risk to reward. You're going to risk $280 for a maximum reward of $2,220. So let's take a look at that on the risk graph. So if we look at this on the risk graph and stretch it out a little bit, we're going to notice that we are sitting right here at 271.43. That's our current price. So being that this is a bullish move, we are actually making a directional bet. So in this case, the butterfly is not a neutral strategy. It's a directional strategy because we're looking for it to go up. So as this stock price moves up, the value of the butterfly is going to increase. And as the value of the butterfly increases, we're going to profit. So basically it's a week-long trade, and If it does not move up and it does not get into this pyramid cone, it's going to expire worthless, and we're going to lose the maximum that we could lose unless we close it out earlier. But like I said, these trades can be like lottery plays because you're basically risking a little to make a potential of a lot of money on these, relatively speaking. I typically look to make 20 to 25% on these because these trades, it's very, very difficult to know that a stock is going to finish right here where you could make that amount of money. But once it starts getting in this cone and this thing starts raising it in value proportionately, you could make money really quick on this thing. I mean, if this thing moves up $2 and it starts heading into this tent, this value is going to go, it could practically double right away, because remember, the spread is making money. You're making money on the spreads. It's two different spreads. So that's basically how a butterfly works. And we can take a look at another stock on this, and we could look at something that's very expensive. Let's look at Priceline. Okay, same thing. Let's look that Priceline is $1,454. Now, we could never dream of buying this stock. This stock would cost us $145,000 to buy 100 shares. Well, I'm certainly not going to do that. But if I want to do a butterfly on it, and I think the stock, look at how they maxed the move out right here at 37 points, $37. So at $37 plus $1,454 puts us somewhere around $1,490. So if I wanted to go out to $1,490, let's open this up and let's get all the strikes out here. So let's go to $1,490. And we're going to build a butterfly. So we're going to buy a butterfly. And in this case, let's do it 10 wide. Let's go to 80, and let's go to 1,500. So now I have 20 wide between 1,480 and 1,500, and it's only going to cost me 85 cents for one contract. Now for that 85 cents, how much could I make? I can make $915 for an $85 investment. That's what butterflies do for you. It's a very low entry, low risk trade with a high reward, but it has a probability that isn't as high as some of the other strategies. Everything in options is a trade-off. You have to understand that. But a butterfly is a way of really putting on an inexpensive trade that could potentially make you a lot of money. And let's look at this risk graph. And with something like Priceline, it's going to be very tight. But you could see the pyramid shape on how once it starts going into this profit zone or into the pyramid, the profits just explode. I mean, you know, a couple of dollar move and you are making some really nice money. I mean, look on the left hand side how this number here, how it just increments as I jump into there. So basically, that is the basics of a butterfly without getting into the Greeks and without getting fancy and all that. It's basically two different spreads. Your middle strike is going to have twice as many of each of the outer wings. These are called the wings. The two options that you buy are the wings, and then the sweet spot or your target is the option that you're going to sell. So if you understood the spread strategy, this is basically two spreads. One is a debit spread, one is a credit spread. And when you put them together and they're equidistant, it's called a butterfly. And that's all it is. And that's all options really are, is just taking calls and puts and combining them in different ways to put strategies together that give us different opportunities to make money on them. So look forward to your questions. We could do some live examples, and we could do some of the stocks that you like when we do our forum. but you can keep referring back to this video, and this is as simple as they are. Okay, hope it helped. Thanks.